Hi, this is Greg Weldon with the Metal Monitor Macro Market Update for the week of October 26th. And man, are we having some fun now? We got the elections coming up. We have the European Central Bank coming under scrutiny. Spanish situation continues to develop. And now you have Spain on the radar screen. A lot to talk about. First thing we're going to look at is central banks. Central banks have pledged to expand their balance sheets. They have been expanding their balance sheets. The Japanese central bank here in purple, this is the percent change going back to the beginning of 1999. Percent change in central bank balance sheets. Red is the Fed. The orange line is the ECB, and the purple is the Bank of Japan. You can see, whereas certainly throughout the decade of the 2000s, the BOJ was the leader in terms of expanding their balance sheet. That has not, that situation is completely reversed, where the BOJ is way behind the curve. BOJ has a major problem on its hands here. We're going to talk about that in a minute. But just to illustrate that central banks are easing. The degree to which they're easing is still kind of unclear. We look at the Fed. Most recent weekly data has shown, expanding balance sheet, purchase of MBS, fairly significant. The path for the next 12 months is defined by the monthly purchases, and it puts us here relative to where we are now. So it's a flatter line than what we saw certainly in QE1 and TARP and in QE2 and TWIST. But it extends out further, so that's kind of what the Fed's playing, in terms of their market expectation and market manipulation. But really, there remains, a question mark as to whether the Fed will have to do more with treasuries down the road. They've left the door open for that. So as it stands now, here where it is, ECB even more in question because basically they're doing nothing. Their balance sheet is actually shrinking a little bit, as has the Fed's up until now. But really, they have pledged to do a lot, but they've given us no idea, no timeline, no specifics about how any of that works. So right now, we project out a flat line because the reality is a flat line. And then the BOJ, here is the current path. They're expected now to increase their asset purchase program by up to 20 trillion yen next week on Tuesday at their next meeting, and that would be the path there. They're under a lot of pressure from the IMF and a variety of international institutions to become more aggressive as Japan starts to face an increasingly difficult problem. What makes all this interesting is that when we look in gold terms of yen in red, Eurocurrency in blue, and then the dollar, regular gold, spot gold price in black, we see here how, the yen gold led the way. Now it's Euro gold leading the way, and potentially now the dollar gold has kind of broken away and is now potentially leading to the downside. Very similar dynamic to what we saw right here in early 2012 that led to a significant decline in gold. So we are on the alert for this as it relates back to this, where this pattern for sure is not what the market expects. And if you get anything remaining in this, even if you go out to the end of the year and the ECB's done nothing, it becomes more problematic as these countries continue to have to roll over more and more debt. Same in the U.S. with treasuries, certainly the same in the case of the BOJ. So yeah, they're easing, yeah, that's bullish, but the degree of their easing may not be enough to support, new all-time highs in gold. It supported the move we expected. We expected a move to 1800, 1805, 1792 to 1805 was our target. We got it. We're a little concerned by this. We're a little concerned about the ECB, and their sideways dynamic. When we look at the dollar, it's another interesting thing because, people talking about gold at new highs, dollar is not anywhere near new lows. In fact, it has not even gotten to the 50% retracement of its first wave up. Yeah, head and shoulders pattern looks ugly. Yeah, violation of the moving average. Yeah, the moving averages have rolled over. Yeah, the stochastic has rolled over. The dollar has declined. Gold has rallied. That is the bottom line. But here, we notice today, thrust higher in the dollar. In fact, dollar renminbi thrusting significantly off new all-time lows yesterday. New, post delinking lows at least. So that was interesting to see. And on the back of that today, the dollar index is a little higher, threatening to try and clear this 80-20 area. And then you have all the way up here to the 200-day at 80.65. You got to get above that and probably back above the neckline at 81.16 before you start saying that, this is a correction that's over. It certainly could be. You have a higher low. You have the Fibonacci numbers working for you here. So we'll keep an eye on the dollar. The fact that the dollar has not declined to new lows, I think, speaks for itself in terms of what the Fed is doing relative to QE1 and QE2. QE3 is less than half the size of QE2 as it stands right now. 45 billion, 40 to 45 billion versus 92 to 97 billion in QE2. Gold, still a corrective move lower though. I mean, We do have the 38% retracement. Man, you nailed it within a dollar here. And we were looking at this very closely last week. Bang online, reversal day here off this low on Wednesday. So that's kind of interesting. You are pressing in this morning and then reversing back up again. So it'll be very interesting to see how this kind of plays out in a candlestick pattern by the end of the day and leading into Monday's action. But you also have the 100-day moving average right here. Man, really interesting convergence. Technically, that's the low right now, 1698.60. You could break it and come down to the 200-day, which is bang in line with the 50% retracement of this move from this low to this high. This is a tight zone of support. You see our long-term trend oscillator continues to improve now with both the oscillator itself and the moving average of the oscillator above zero, and that's positive. When we tighten it up and look at a very close-up chart, you can see the action here, and we've since reversed back to the upside. Right now, gold is up $2.20, so it's back up into this zone, trying to make new highs on the day, in fact. So, it's no longer down here where this slash indicates. It was testing this low. Should you take out yesterday's high, and you're very close to that, just in the 1720 area, that would be kind of interesting in a potential reversal pattern off the Fibonacci. Off the 100-day moving average, which was not violated. So this is a pretty tight pattern. Definitely close attention to this level here, 1698.70, over the next 2 to 3 trading days. Gold and euro came right down into our zone. This is the same chart from last week. We had this zone zoned in, the 50% and 38% of this move here from 1212 to 1378. Bang, right into it, reverse back above the 100-day moving average. You do have negative moving average dynamic here. The short term, 1 month below the 50, the 100-day has flattened out, threatening to roll over. You still have room down to 1295, where you have the 200-day and the 50% retracement, so it could be A, B, C. Come back up here to this moving average convergence, then back down here, and that's a correction. Remains to be seen. It is all predicated upon the ECB, walking the monetary walk. They have talked the monetary talk. Will they walk the walk? Will they do it to the degree that the market is anticipating? And if not, then that could be problematic, and you would see, gold in euro terms below 1295 very quickly, I think. Same thing in Japan. Again, if they don't now ease next week, it's expected here. The last time they did this, a month ago, September, it wasn't expected. In fact, we said, expect the unexpected. Well, right now, it's fully expected that they'll ease. If we were to say expect the unexpected, which we're not, that would suggest they're not going to ease. Maybe they don't want to be pressured politically. This has become a real political situation in Japan. We wrote about it yesterday. Very much, again, this chart deserves close attention. It could be a triple top, or it could be just a continuation of this longer-term bull market that is held at the 200-day with a positive longer-term oscillator dynamic. This is a weekly chart, so very interesting here. The 140,000 yen per ounce level remains key. You see it above there, you're going to make a run at new highs, especially if that comes in context of something from the BOJ. There's also talk they could buy stock index ETFs and REITs, and you'll notice within the stock market in Japan, the REITs have significantly outperformed just in the since June. So it's pretty interesting to note that dynamic, as the expectation is that the BOJ will not only expand their asset purchase program, but expand and intensify the types of assets that it will attempt to reflate. We look at the yen. We are very closely watching the yen. We want to be bearish on the yen. There's certainly risk here in being bearish on the yen. The risk being, if you have an implosion in Japan, that it's a repatriation dynamic, and you see a black hole dynamic where liquidity gets sucked out of the global markets in a move back to Japan to fund their own fiscal deficits. That is a risk, but the correlations would suggest the yen is at risk here. We don't have that chart in here, but it's interesting to note nonetheless. And we see the breakdown of this low here. You're below the 200-day moving average, which is rolling over. You have a pretty tight little topping pattern, and you're threatening the trend line here as well. And as we look at the screen right now, the yen is up significantly. So we're back towards this trend line here, or in the 125 zone. But nonetheless, we are very much interested in keeping an eye on the yen here, thinking you have a real chance for a breakdown. You'll notice here, too, how this is failing to make a new high here for the first time. This is a sequence of higher highs all the way up until now, and this high here was not confirmed by the stochastic indicator. Here's the high in the stochastic, was this price high. This high is totally unconfirmed, and now you're at even a lower high. You have like a triple, it's not divergence at the third high here because it's not a new price high, but it is kind of this triple peak rollover that you have in the stochastic off of here. Certainly a move below 124.44 in the yen futures would be bearish for the yen. The dynamic in Japan is, against the political backdrop, which is very uncertain as it is in the U.S. In fact, you have, they're missing their inflation target. The BOJ comes with quarterly adjustments to their macro forecast. I think it's biannual, actually, adjustments to their macro forward forecast. It'll be the first read on their expectations for 2014. They're expected to cut GDP and inflation forecasts, more importantly, for 2012 and 2013. And already, inflation is way below target. They're looking for 1%. The opposition, LDP, which was in power for 50 years until 2009, wants 3% as the target. That's how aggressive they want the Bank of Japan to become. So it's not even a question of, the opposition is against fiscal and monetary stimulus. The opposition wants even more. So it's pretty interesting in terms of that, and the election coming up. No date yet been set on that, but has to be called soon. And we look at inflation below target, negative. Moving averages are negative. Don't see anything in the dynamic, particularly in their macroeconomic situation, that suggests that they're going to have a rise in inflation, for its own. So don't see that happening. In terms of gold mining shares, to shift the focus a little bit here, we look at Anglo-Ashanti as at basically what is a new low. There's a monthly chart going all the way back to 97. New low in Anglo-Ashanti against gold. There is real turbulence in these mining shares, and it's pretty interesting. It's paper versus stuff. It really embodies a lot of stuff. It's also stock market against mining shares, stock market outperforming. So that also has hurt the mining shares as some of that money rolls out into other areas of the equity market. But when we look at Anglo-Ashanti Gold here, 3056 is this low. It's a triple low. Matches beautifully with the Fibonacci numbers that we don't have on here. We look at the moving averages, great, lower high into the 52-week moving average. Moving averages widening a negative gap, and you have now the 6-month rate of change rolling back into negative territory. A move below 3056 would be negative for Anglo-Ashanti, and could be symptomatic of a bigger picture problem in terms of the mining shares, and that's particularly true if central banks don't step up to the plate, particularly in Europe, and you get a further deeper correction in gold. Silver, bang into line with our support levels. This is the lines we drew last week in terms of the 50 and 38% retracement of the entire move here from the low. Okay, in the same zone with the two moving averages, the 52-week and the 2-year. And here it is. You're bidding for a reversal week here. This week today, should silver close higher, it will be not hugely significant, but notable for sure from a medium-term perspective that silver came down right into the zone we anticipated in the Fibonacci's and moving averages, and is threatening to reverse higher on the week. We still like silver on a long-term basis. Palladium, psychotic. Platinum and palladium been very tough, man. This has really been, whipsaw city, very difficult to trade. Gotten stung a few times here. Right now, palladium and platinum, under fire. Industrial metals, generally speaking, it's a risk to silver as well, but more so in palladium and copper and the LME metals. Under pressure here because economies are not responding, nor do we think they would respond anyway to quantitative easing, and they're getting worse. Quantitative easing is not the elixir of hope for macroeconomic dynamics, which continue to worsen around the globe, pretty much in every sector of the globe, and you're starting to see that again reflected in industrial metal prices. Here's palladium, back below the moving averages rolling back to the downside. Very short-lived rise here in the 52-week moving average. Stochastic again, short-lived bullish crossover, now back to bearish. 555 is key level in terms of palladium. A move below that would clearly from a long-term technical perspective be negative. Weakest link, nickel. We're watching nickel, have been watching nickel, very telltale. You see it got right back to this trend line. We had this trend line in when it was broken. We left it in, and look what happens. You go right to it, right to the zone between the two moving averages, and fail. And now you're back on the ropes here. Big down week this week. 15,236 is your low. Keeping it in mind, stochastic never bullish throughout this entire rally. Neither were the moving averages. Continue to watch. Technically looks negative here for sure. When we look at inventories in nickel, you can see the rise off the October of last year low. So in 12 months, nickel inventories are up over 50%. That is a significant rise. It's not as big as what you saw in 2008 and 2009, but it's a significant increase in LME exchange-held inventories of nickel. You also see that the 3-month rate of change is at 26%. So not only has it been a large rise over the last 12 months. It's accelerated in the last 3 months at a faster pace than the 12-month rate. So interesting dynamic to look at the increased inventories of nickel. And then we see the forward swap responding to an increase in inventories by moving from backwardation, where the near-term 3-month contract commands a price premium to the 27-month as it tries to draw metal into the market because there's a supply-demand imbalance on the bullish side for price, now into contango, meaning the nearby contract trades at a price discount. So people are paid to store nickel because there's plenty around. It's not being used. That's the dynamic here into contango. You really haven't been in contango, hey, since 1999. And this is the 52-week moving average of the weekly spread between the 3-month and the 27-month forward. The 27-month forwards are very actively traded LME contracts, so we do this comparison because of the liquidity here and because of the fact that it's a 2-year spread between these two time frames. So very interesting to note within the context of rising inventories, a breakdown in price, and a real collapse into contango in the spreads. Copper, interesting. Again, trend line, retesting, below the moving averages. Moving averages were trying to cross bullishly. Now that's in doubt. Pretty interesting pattern. This looks like it wants to be bullish, but it's not yet. This looks like it wants to be bullish, but it's not yet. And now you're kind of testing the metal here, no pun intended, of the market. And you see a move below 331.70 would be negative. Really, below 311 needs to happen for this to be an all-out bear attack. On the flip side, now, with this setup, if this market were to get back above 385.20, it would be quite bullish because you would have the moving averages expanding positively. You'd have this thing kicking into a positive directional move. So we're keeping an eye on that. For now, kind of caught in the crossfire in a 50-cent range here. Don't see much impetus, trend-wise either way until one of these levels is broken. Tin, in line with nickel, breaking down below the 100-day moving average, below the 50. The 50's rolled over. Nice head and shoulders top right at the 38% retracement of this move from here to here. Didn't even reach the 38% retracement of the bigger picture move, and now threatening to break down, looking to retest the 17,000 level. Tin in that category of industrial metals that look weak on the back of weakening macroeconomic data around the world. And then there's zinc, zany zinc, breakdown here, don't go anywhere, break out here, don't go anywhere, break down here. I mean, man, LME metals have been very difficult to trade. They're going nowhere, but they're getting a lot of vacillation while going nowhere. So it's been tough. And we see here zinc threatening to break down, back below the moving averages, back below the giant triangle pattern. This threatening to roll back to the downside or long-term oscillator. A move below 1750, about $100 away for zinc would be clearly a negative sign as it relates to all of these industrial metals. Bottom line, still stacking up bullishly for the most part on gold and silver from central bank dynamic, but the fact that industrial metals are breaking down and that macroeconomies are coming under pressure does bring us to our concern that central banks are not doing enough. Not that it's academically correct or we feel they should do anything. The bottom line is they will be forced to do something. Better to do it now rather than later. Maybe not. Maybe it takes pain. Maybe they're willing to accept some deflation. We see it happening in macroeconomies. We see it happening in industrial metals now. Next stage would then be to see it start to unfold in the precious metals, and we think that would get the attention of central banks real fast, particularly in Europe. So a lot to watch for, a lot going on. For right now, we remain long-term bullish on gold and silver. That's it for this week. Thanks a lot.